Something extraordinary is happening in the silver market right now. We're witnessing what veteran traders call a liquidity crisis. Physical silver is sold out at major dealers. Premium spreads have exploded to levels not seen in decades. And in some trading sessions, there have been moments with literally zero bids on the sell side. Meanwhile, silver prices have shattered all-time highs, surging past levels that seemed impossible just months ago. This isn't normal market behavior. This is the kind of dislocation that appears maybe once or twice in a generation. The kind that separates those who understand market structure from those who simply react to headlines. If you own silver, you need to understand what this means for your position. If you've been considering silver, you need to know whether this is opportunity or danger. And regardless of where you stand, you need to grasp the deeper forces at work here. Because what's happening in silver right now isn't just about one metal. It's a signal about monetary confidence, industrial demand, and the fractures appearing in financial markets that have operated a certain way for 40 years. This is a moment that demands clear thinking, not emotional reaction. Let's examine exactly what's occurring, why it matters, and how to navigate it with discipline and intelligence. First, let's establish what we're actually seeing. When we say silver is sold out, we're talking about physical metal at retail dealers and wholesale distributors. Major online dealers are showing out of stock notices on popular products. Mints are reporting delivery delays, stretching weeks or months into the future. This is physical scarcity, real metal that people can hold. But here's where it gets interesting. At the same time, paper silver markets, the futures contracts, and exchange-traded products are showing something different. Massive volume, extreme volatility, and at certain moments, bid-ask spreads that indicate serious stress in the market-making system. What does zero bids actually mean? It means that for brief periods, there were no buyers willing to step in at any price on the sell side. Think about that. In a functioning liquid market, there's always someone willing to buy, even if the price has to drop significantly to find them. When bids disappear entirely, even for seconds, it reveals something. The normal market participants who provide liquidity have stepped back. They're uncertain. They're unwilling to take the other side of trades because they can't accurately price risk. This is not a sign of market health. This is a sign of structural stress. Now, why would physical be sold out while paper markets show stress? Because these are two different markets with different participants and different dynamics. Physical buyers are individuals, small institutions, and entities that want actual metal. They're not leveraged. They're not trading on margin. They're converting currency into a tangible asset and holding it. Paper market participants include banks, trading firms, hedge funds, and speculators using leverage. They're trading contracts, not metal. And when volatility explodes, leverage becomes dangerous. The divergence between these two markets is widening. That divergence itself is information. It tells us that trust in paper claims on silver is being questioned, while demand for physical possession is intensifying. Silver has been here before. Not exactly like this, but similar enough that history offers guidance. In 1980, silver briefly touched $50 per ounce during the Hunt Brothers episode. That was a leverage-driven bubble that collapsed spectacularly. People who bought at the top waited decades just to break even. In 2011, silver again approached $50, driven by post-financial crisis monetary expansion and fears about currency debasement. That rally also reversed sharply, leaving late buyers underwater for years. But here's what's different now. The industrial demand profile for silver has fundamentally changed. Solar panels, electric vehicles, electronics, medical applications, all of these sectors consume silver in ways that didn't exist or weren't scaled in previous decades. Silver is now essential industrial infrastructure, not just a monetary metal or inflation hedge. At the same time, primary silver mining hasn't kept pace. Most silver is actually produced as a byproduct of copper, zinc, and lead mining. When you mine for those metals, silver comes along. But there are relatively few pure silver mines. This means silver supply doesn't respond quickly to price signals the way other commodities might. You can't just turn on silver production. The supply curve is relatively inelastic in the short to medium term. Add to this the monetary environment. We've lived through unprecedented currency creation since 2008. Then came the pandemic and another wave of fiscal and monetary expansion that dwarfed anything before it. Central banks around the world are holding interest rates at levels that, historically speaking, are still extraordinarily accommodative even after recent hikes. Government debt levels have exploded. Currency debasement is not a theory, it's observable policy. In this context, hard assets have appeal, not as speculation, but as insurance against monetary instability. Silver sits at the intersection of industrial necessity and monetary insurance. That's a very different setup than 1980 or 2011. Markets are made of people, and people are driven by emotions, especially in moments of uncertainty. Right now, several psychological forces are colliding. First, there's FOMO, fear of missing out. As prices hit new highs, people who've been watching from the sidelines feel urgency. They see their purchasing power potentially eroding. They see others profiting. The emotional pull is to jump in. This is natural. It's also dangerous when it leads to decisions made in haste without proper analysis. Second, there's validation seeking. If you've held silver for years, perhaps through periods when it languished and people questioned your judgment, these new highs feel like vindication. That emotional satisfaction can cloud judgment about when and whether to take profits or rebalance. Third, there's fear. Fear that the monetary system is breaking, fear that inflation will accelerate, fear that some kind of currency crisis is approaching. Fear is a powerful motivator, but it's a terrible decision-making framework when it becomes panic. Fourth, among those who don't own silver, there's often denial or rationalization. It's a bubble. It'll crash like before. I'll wait for a pullback. These may be true, or they may be emotional defense mechanisms to avoid the discomfort of potentially missing an important move. Understanding your own psychology in this moment is critical. Ask yourself, what am I feeling right now? Am I making decisions based on analysis or emotion? Am I trying to get rich quick, or am I building a long-term position? Am I following a plan, or am I reacting to daily price movements? The investors who survive and thrive through volatile periods are those who can separate their emotional responses from their strategic decision-making. Let's zoom out and look at the bigger picture. Silver doesn't move in isolation. It's responding to forces much larger than the metal itself. First, there's the ongoing shift in global monetary confidence. The US dollar has been the world's reserve currency for 80 years. That status is being questioned more openly now than at any time in modern history. BRICS nations are exploring alternative payment systems. Central banks globally have been accumulating gold at rates not seen in decades. There's a slow but unmistakable move toward diversification away from dollar dominance. When confidence in the primary reserve currency wavers, even slightly, money seeks alternatives. Gold is the traditional haven. Silver often follows with more volatility due to its smaller market size. Second, there's the industrial electrification trend. The global push toward renewable energy and electric transportation isn't a fad or a political talking point. It's trillions of dollars in infrastructure investment over decades. Solar panels use significant silver. Electric vehicles use more silver than traditional cars. 5G networks, data centers, advanced electronics, all of these consume silver. This creates baseline industrial demand that's growing and relatively inelastic. Manufacturers need silver to build products. They can't easily substitute. They have to buy it, regardless of price, within reason. Third, there's the debt overhang. Major economies are carrying debt to GDP ratios that historically have only been seen during major wars. The mathematics of this debt suggest only a few possible outcomes. Sustained economic growth that outpaces debt accumulation, default or restructuring, or inflation that devalues the debt. The first option seems increasingly unlikely given demographic trends and productivity challenges. The second is politically unacceptable. That leaves the third. Inflation, whether acknowledged or disguised through various measurement changes, functionally transfers wealth from creditors to debtors. It's a stealth form of default. And in that environment, tangible assets tend to preserve purchasing power better than paper claims. Fourth, there's geopolitical instability. We're seeing a reconfiguration of global power structures. Trade relationships are fragmenting. Supply chains are being reconsidered with security, not just efficiency, in mind. In uncertain geopolitical environments, assets that aren't someone else's liability become more valuable. Silver, like gold, is no one's promise. It's an element. It exists regardless of government stability or institutional solvency. These forces don't guarantee silver prices will rise forever, but they do explain why we're seeing the kind of demand intensity that leads to shortages and liquidity crises. If you already own physical silver, you're in a position many others wish they were in. But this is not a time to become complacent or emotionally attached to your position. You need a clear framework for decision-making. First, ask yourself, what was my original thesis for buying silver? Was it insurance against monetary instability? Was it speculation on price appreciation? Was it industrial demand growth? Was it portfolio diversification? Your original thesis matters because it should inform your current actions. If you bought silver as long-term insurance, then short-term price movements, even dramatic ones, are largely irrelevant to your core holding. You don't sell your fire insurance because home prices went up. But if you bought as a speculation, hoping to profit from price appreciation, then you need to think about profit-taking, position sizing, and exit strategies. Second, consider your position size relative to your overall wealth. There's an old guideline in precious metals investing that suggests holding between 5 and 15% of your liquid net worth in physical precious metals. If silver's recent price surge has pushed your allocation above your target range, it may be time to rebalance. This isn't about market timing. It's about maintaining the risk profile you designed. Taking some profits after a substantial run-up isn't bearish. It's disciplined. It locks in gains, it reduces concentration risk, and it gives you dry powder if prices pull back and you want to re-enter. Third, think about the form of your silver holdings. Do you own physical coins and bars that you possess? Do you own ETFs or other paper claims? Do you own mining stocks? These are very different risk profiles. Physical metal you possess has no counterparty risk. ETFs have structural risks, including the possibility that physical metal isn't fully backing the shares as advertised. Mining stocks are businesses subject to operational risks, regulatory risks, and management decisions. In a scenario where trust in financial institutions is eroding, physical possession becomes more important. If you own paper claims on silver, you might consider whether some portion should be converted to physical. Fourth, avoid the trap of anchoring to current prices. Just because silver is at all-time highs today doesn't mean it can't go higher. It also doesn't mean it won't correct sharply. Your decisions should be based on your thesis, your position sizing, and your risk tolerance, not on whether today's price is high or low relative to yesterday. Fifth, prepare emotionally for volatility. If you think the recent price movement has been dramatic, understand that volatility likely increases from here, not decreases. Silver can move 10 or 15% in a day. It can drop 20 or 30% in a week, then recover just as quickly. If you're not prepared for that psychologically, you'll make mistakes. The way to prepare is to accept that volatility is the price you pay for the potential upside and the insurance value. If you can't stomach it, reduce your position to a size where you can sleep at night. If you don't currently own silver but you're considering it, you're facing a difficult decision. Prices are at all-time highs. Premiums are elevated. Availability is constrained. It feels like a terrible time to buy. Maybe it is. Or maybe we're at the beginning of a much larger move and today's prices will look cheap in hindsight. No one knows. Anyone who tells you they know with certainty is either lying or deluded. But you can make a rational decision based on your circumstances and your analysis. First, define your purpose. Why do you want silver? Be specific. Not everyone is buying it or prices are going up. Those aren't theses. Those are following the crowd. Are you buying because you believe monetary debasement will continue and you want to preserve purchasing power? Are you buying because you believe industrial demand will continue to exceed supply? Are you buying because you want a portion of your wealth in an asset that's no one's liability? Whatever your reason, write it down. Because when prices inevitably become volatile, you'll need to remember why you bought. Second, if you decide to enter, don't go all in at once. This is true for any volatile asset, but especially for one at all-time highs. Consider dollar cost averaging. That means buying a fixed dollar amount at regular intervals, regardless of price. Maybe you allocate $10,000 to silver and buy $2,000 worth each month for 5 months. This smooths out your entry price. If silver continues up, you still participate. If it corrects, your later purchases are at better prices. You avoid the psychological trauma of putting everything in at the top. Third, focus on physical metal. First, paper claims. Second, if you're buying silver as insurance or as a hedge against financial system instability, then paper claims defeat the purpose. Yes, physical has higher premiums right now. Yes, storage is a consideration. Yes, it's less liquid in the sense that you can't sell it with a mouse click. But those inconveniences are features, not bugs. They force you to hold for the right reasons. They ensure you actually own an asset, not a promise. If you do buy paper silver through ETFs, understand what you own. Read the prospectus. Understand the fee structure. Understand whether the fund can deliver physical metal if you wanted to redeem shares. Most can't or won't. Fourth, accept that you might be wrong about timing. You might buy today and watch prices drop 20% next month. That's a real possibility. If that possibility would cause you to panic sell, then don't buy, or buy a smaller position, or wait. But if you're buying for long-term fundamental reasons, then short-term drawdowns are not disasters. They're opportunities to add at better prices. Fifth, do not use leverage. Do not buy silver on margin. Do not take out loans to buy silver. Do not drain your emergency fund to buy silver. Leverage turns volatility into liquidation risk. The people who get destroyed in volatile markets aren't usually those who own assets outright. They're those who own assets with borrowed money and get forced to sell at the worst possible time. Buy only what you can afford to hold through severe volatility. If that means you buy less than you'd like, that's fine. Survival is more important than maximizing potential gains. Let's talk about the actual supply and demand dynamics, because understanding these is crucial to evaluating whether current prices are justified or speculation. Global silver mine production is roughly 830 to 850 million ounces per year. This number hasn't grown significantly in recent years, despite price increases, which tells you something about the difficulty of expanding supply. About 75% of silver production comes as a byproduct of mining other metals. Only about 25% comes from primary silver mines. This is important because it means silver supply doesn't respond to price the way other commodities do. If copper demand is weak, copper mines slow down and silver byproduct falls too, even if silver prices are high. The supply curve is partially controlled by metals that have nothing to do with silver's own market dynamics. On the demand side, industrial use consumes about half of annual supply. Solar panels alone now account for roughly 140 to 150 million ounces annually and growing. Electronics, medical, automotive, and other applications consume hundreds of millions more ounces. This industrial demand is relatively inelastic. Manufacturers need silver to build products. While they can sometimes reduce usage or substitute at the margins, they can't eliminate it. If you're building solar panels at scale, you need silver. There's no practical alternative at current technology levels. Investment demand adds another layer. This includes coins, bars, ETFs, and other investment vehicles. This demand is highly elastic and sentiment-driven. It can surge or collapse based on market psychology. Then there's the question of above-ground supply. How much silver exists in the world in various forms? This is surprisingly uncertain. Some silver sits in central bank vaults. Some is in private vaults. Some is in jewelry. Some is in industrial products, effectively consumed and not economically recoverable. Estimates vary, but total above-ground silver stocks might be around 2 to 3 billion ounces in investable forms. Compare that to gold, where above-ground stocks are over 200,000 tons, or roughly 6.4 billion ounces, despite annual gold production being lower than silver. Why does silver have lower above-ground stocks despite higher annual production? Because it's been consumed industrially for decades, while gold has been largely hoarded. This creates an interesting dynamic. There's less existing silver available to meet a surge in investment demand compared to gold. The market is smaller and potentially more prone to physical shortages. Now add in the question of paper claims versus physical metal. The futures market and various financial products create paper claims on silver that far exceed actual physical metal available for delivery. This isn't unusual in commodities markets. It's how price discovery works. Most futures contracts are settled in cash, not physical delivery. But when trust in the system wavers, when large numbers of holders suddenly want physical instead of paper, that's when you get delivery squeezes. That's when premiums explode. That's when zero bids appear because market makers can't source physical to back their paper positions. We may be seeing the early stages of that dynamic now. Let's be very clear about the risks because they are substantial and real. First, silver could correct sharply at any time. All-time highs are often followed by significant pullbacks. That's not a prediction. It's an observation about how markets work. Buying at all-time highs means you have no price support beneath you. There's no historical level where buyers previously stepped in. You're in uncharted territory, which means the downside, if it comes, could be severe. Second, if you own paper silver, you have counterparty risk. The institution holding or promising you silver could face solvency issues. The fund structure could fail. Regulatory changes could impact your ability to access your investment. Physical possession eliminates counterparty risk, but introduces different risks: theft, loss, the need for secure storage, and potentially reduced liquidity when you want to sell. Third, silver remains a relatively small market. That makes it more volatile than larger markets and potentially more susceptible to manipulation or major price swings driven by relatively small capital flows. A few $billion flowing into or out of silver can move prices dramatically. In larger markets like equities or bonds, that same amount barely registers. Fourth, you could be wrong about the fundamental thesis. Maybe monetary authorities successfully manage inflation down. Maybe industrial demand growth slows due to recession or technological substitution. Maybe geopolitical tensions ease. If the forces you believe are driving silver prices shift or reverse, prices will follow. Fifth, opportunity cost. Money in silver is money not in other assets. If equities or real estate or other investments outperform silver significantly, you've potentially missed better opportunities. There's no perfect asset. Every choice involves trade-offs. Sixth, regulatory risk. Governments have historically changed rules around precious metals ownership during periods of financial stress. While outright confiscation seems unlikely in most developed economies today, taxes, reporting requirements, or restrictions on buying and selling could change. Understanding and accepting these risks is not pessimism. It's realism. It's how you avoid being blindsided. Here are the behavioral and strategic errors that destroy wealth during volatile market environments. Avoid these, and you'll already be ahead of most participants. If you're buying because prices went up and you're afraid of missing out, you're making an emotional decision. Emotional decisions in volatile markets usually end badly. Have a thesis. Have a plan. Execute it, regardless of whether prices are rising or falling in the short term. This point bears repeating because it's so commonly violated and so destructive. Silver can move against you so quickly that leveraged positions get liquidated before you have time to react. Own your assets outright, no exceptions. Silver is volatile. It's a liquid in the sense that converting physical to cash takes time and incurs costs. If you need money quickly and have to sell silver at an inopportune moment, you'll take losses you could have avoided. In many jurisdictions, silver is taxed as a collectible at higher rates than ordinary capital gains. Understand the tax treatment in your location before you buy and before you sell. Tax bills can significantly eat into profits if you're not prepared. If you own physical silver, you need a plan for keeping it safe. Home storage has risks. Bank safety deposit boxes have risks, including potential access issues during banking crises. Private vault storage has costs and counterparty risks. Think through these issues before you accumulate significant holdings. They're not. An ETF share is a financial product with its own risks. A physical coin is an asset you possess. These are fundamentally different, and if you don't understand the difference, you're exposed to risks you may not realize. Silver is a tool, not an identity. Whether you own it or don't own it says nothing about your intelligence or worth. If your thesis changes or your circumstances change, be willing to adjust. Ego and attachment destroy clear thinking. Very few people can successfully trade volatile markets. Most who try end up with worse results than if they'd simply bought and held or stayed out entirely. Every trade incurs costs, taxes, and the risk of being wrong about timing. Even if you're very bullish on silver, having your entire net worth in one asset is reckless. Diversification reduces the impact of being wrong about any single position. It's not exciting, but it's essential for long-term wealth preservation. Anyone telling you silver will definitely hit a specific price by a specific date is either guessing or selling you something. Markets are complex adaptive systems. Outcomes are probabilistic, not deterministic. Make decisions based on scenarios and risk management, not price predictions. Your situation determines your strategy. Let's outline frameworks for different circumstances. Start with a small position, perhaps 1 to 3% of liquid net worth. Buy physical, store it securely. Add to it gradually over time if your thesis remains intact. Don't worry about timing the absolute bottom. You're buying insurance, not making a trade. Define your speculative capital, money you can afford to lose completely. Allocate only that amount. Consider dollar cost averaging over 3 to 6 months. Set a mental stop loss, a price where you'll admit you're wrong and exit. Take profits in stages if prices run significantly in your favor. Use the same gradual approach. Don't dramatically increase your allocation just because prices went up. That's backwards. If anything, rising prices should make you more cautious about adding, not less. Review your original thesis. If it's still valid, hold your core position regardless of short-term price action. But consider whether your allocation has grown too large relative to other assets. If it has, take some profits to rebalance. Lock in gains, reduce concentration risk. This is psychologically difficult, but you have to separate sunk costs from current decisions. The fact that you bought at a higher price doesn't mean you should hold now if your thesis has changed. Equally, it doesn't mean you should sell just to avoid the pain of a loss. Evaluate the position based on current conditions and future prospects, not past mistakes. Reduce your position to a size where you can sleep comfortably. There's no prize for having the maximum possible silver allocation. Wealth preservation and peace of mind matter more than maximizing every possible gain. What's happening in silver is not isolated. It's part of a broader pattern of stress signals appearing across financial markets. Bond markets are showing volatility unseen in decades. Government bond yields in major economies have moved in ranges that historically accompanied crises or major regime changes. Currency markets are experiencing unusual correlations and breakdowns in historical relationships. Traditional safe haven currencies aren't behaving as expected. Real estate markets in major economies are under pressure from high interest rates meeting elevated valuations. Commercial real estate, particularly office space, is facing structural challenges that may take years to resolve. Equity markets are showing extreme concentration, with a handful of mega-cap technology stocks driving most of the gains while breadth weakens. This is typically not a sign of healthy, sustainable market strength. Commodity markets more broadly are showing supply constraints and price volatility that suggest physical scarcity is becoming a theme across multiple resources, not just silver. Banking sector stress, while contained for now, remains elevated by historical standards. Deposits have migrated from smaller banks to larger institutions. Credit conditions are tightening. Bank balance sheets contain unrealized losses on bond portfolios that could become realized if liquidity demands increase. What ties these signals together is a question about the sustainability of the current monetary and financial regime. We've run an experiment over the past 15 years with unprecedented monetary expansion, zero or negative interest rates, and debt accumulation. That experiment has consequences. Some of those consequences appear as inflation. Some appear as asset bubbles. Some appear as financial instability. Some appear as geopolitical tension as nations compete for resources and strategic advantage. Silver is reacting to these broader forces. It's one among many signals suggesting the financial system is under stress and may be transitioning to a different regime. That doesn't mean the system is collapsing tomorrow. Complex systems can remain stressed for long periods, but it does mean that assumptions that worked for the past 40 years may not work for the next 40. Throughout history, periods of monetary regime change have been challenging to navigate, but enormously important to understand. When the classical gold standard broke down in the 1930s, those who held physical gold were protected, while those who held currency or bonds denominated in devalued currencies saw wealth destroyed. When the Bretton Woods system collapsed in 1971 and the dollar's gold convertibility ended, we entered a pure fiat currency regime. The following decade saw severe inflation and significant gains in precious metals. When the Soviet Union collapsed and Eastern European currencies hyperinflated, those with hard assets or access to hard currency survived. Those with savings in local currencies were wiped out. When emerging market crises hit in the late 1990s, countries with foreign exchange reserves and diversified central bank holdings fared better than those without. The pattern is consistent. During monetary transitions, tangible assets and assets not dependent on the solvency of specific institutions tend to preserve wealth better than paper claims and currency. We may be in the early stages of another such transition, a move away from the post-1971 dollar-centric system towards something more multipolar, perhaps with a greater role for gold and other hard assets in settling international trade. If that's the case, the current silver surge is not a bubble. It's an early signal of a much larger repricing of monetary assets versus tangible assets. But even if you believe this thesis, it doesn't mean prices move in a straight line. Transitions take years, sometimes decades. Along the way, there are violent reversals, false starts, and periods where old patterns seem to reassert themselves before finally breaking. Your job as an individual managing your wealth is not to predict the exact path. It's to position yourself so you can survive and potentially thrive regardless of which scenario unfolds. That means diversification. It means owning some assets that do well if the system continues functioning roughly as it has. It means owning some assets that do well if the system transitions to something different. It means having liquidity for opportunities and emergencies. It means, fundamentally, not betting everything on one outcome. The greatest challenge in navigating volatile markets is not intellectual. It's emotional. You can understand every concept in this script. You can have a perfect thesis. You can execute a flawless plan. And you can still fail if you cannot control your emotional responses to price movements. When silver drops 20% in a week, your stomach will tighten. You'll feel physical anxiety. You'll question your decisions. You'll wonder if you should sell before it drops further. When silver surges 30% in a month, you'll feel euphoria. You'll wish you'd bought more. You'll be tempted to add to your position at exactly the wrong time. These feelings are normal. They're hardwired into human psychology, fight or flight responses that served us well in physical danger, but sabotage us in financial markets. The way to overcome them is not to eliminate the feelings. That's impossible. The way is to acknowledge them and then act according to your plan regardless of what you feel. This requires discipline. It requires having that plan written down before emotions run high. It requires reviewing your plan when calm and recommitting to it. It helps to understand that market volatility is not happening to you personally. It's just volatility. It's information. Prices moving up or down are data points, not judgments on your intelligence or worth. Your net worth is not your self-worth. This distinction is critical. If you tie your identity to your investment performance, you'll make terrible decisions because every loss will feel like a personal failure and every gain will feel like validation. Markets don't care about you. They're not trying to hurt you or help you. They're just the aggregated actions of millions of participants all trying to navigate uncertainty. Your job is to manage your position in that system with discipline and rationality. Not to be right all the time, not to maximize every possible gain, just to survive and compound wealth over time. That's a more modest goal than getting rich quick. It's also vastly more achievable. Let's address a fundamental question. What role should silver play in a well-constructed portfolio? There's no single answer because it depends on your circumstances, your timeline, your risk tolerance, and your thesis about the future. But we can outline principles. For most investors, precious metals as a category might comprise 5 to 15% of liquid net worth. That's a traditional range that provides meaningful diversification without overconcentration. Within that precious metals allocation, gold typically plays the primary role because it's more liquid, has lower volatility, and has a longer history as a monetary asset. Silver might be 1/4 to 1/2 of your precious metals allocation. So if you hold 10% of your portfolio in precious metals, perhaps 2 to 5% might be in silver, with the rest in gold. This is not a hard rule. It's a starting point for thinking. Silver's higher volatility means it has more upside potential than gold, but also more downside risk. It's a more aggressive position within the precious metals category. If your thesis is heavily weighted toward industrial demand and monetary debasement, you might tilt more toward silver. If you're primarily looking for insurance and stability, you might tilt more toward gold. The point is to make conscious choices based on your analysis, not to accidentally drift into an allocation driven by price movements or emotions. Outside of precious metals, a balanced portfolio typically includes equities for growth and ownership of productive businesses, bonds or fixed income for stability and income, though this is currently challenged by low real yields. Real estate or real assets for inflation protection and income, cash for liquidity, opportunities, and emergencies. Each component serves a purpose. Silver is one piece, not the whole puzzle. If silver performs extraordinarily well and grows to represent 20 or 30% of your portfolio, that's wonderful. But it also means you're now heavily concentrated in one asset. That's increased risk. Rebalancing, taking profits from what's run up and adding to what's lagged, is psychologically difficult. It feels like you're selling your winners and buying your losers, but it's how you maintain the risk profile you designed. Discipline in rebalancing is often the difference between those who compound wealth over decades and those who have spectacular gains that they then give back. No one knows the future. The best we can do is prepare for multiple possible scenarios. In this scenario, silver likely continues to perform well as both an inflation hedge and an industrial commodity in demand for green infrastructure. Physical shortage could intensify. Premiums could remain elevated. Your silver position preserves purchasing power and potentially grows in real terms. In this scenario, industrial demand for silver could drop significantly. Investment demand might initially spike as a safe haven, but if liquidity becomes the primary concern, people might sell silver to raise cash. Prices could fall sharply. Physical silver still has value, but your position might decline significantly in dollar terms, even if its relative value versus other assets holds up better. In this scenario, if central banks successfully bring inflation down without causing a severe recession, and if confidence in fiat currencies is restored, silver might correct significantly from current levels. Industrial demand would continue, but investment demand could collapse. This is the scenario where holding silver at current prices proves to have been mistimed. In this scenario, trust in financial institutions and paper assets breaks down more severely. Physical silver becomes difficult to obtain at any price. Premiums explode to 50 or 100% over spot. The silver you hold becomes extraordinarily valuable, not in dollar terms, because the dollar might be losing purchasing power rapidly, but in terms of what it can buy or trade for. In this scenario, advances in technology allow manufacturers to use significantly less silver in products or substitute other materials. Industrial demand falls. Investment demand might remain, but without the industrial support, prices stagnate or decline over years. Which scenario will unfold? Probably some combination of elements from multiple scenarios that we haven't fully envisioned. The point of thinking through scenarios is not to predict the future. It's to ensure your position and your plan can survive different outcomes. If you're positioned so that scenario 4 unfolding would make you extraordinarily wealthy, but scenario 3 would financially ruin you, you're not diversified. You're gambling. If you're positioned so that scenario 3 costs you some opportunity, but doesn't seriously impact your financial security, while scenario 4 protects you significantly, that's a more robust approach. Think in terms of robust positioning across scenarios, not maximum optimization for one specific outcome. When markets are at all-time highs, the question of timing becomes paramount. Is this the beginning, the middle, or the end? Here's an uncomfortable truth. You cannot know with certainty. No one can. Markets can remain irrational or continue in a trend far longer than seems reasonable. They can also reverse without warning. The people who bought Bitcoin at $300 felt foolish when it dropped to $200. Then it went to $20,000. Then it crashed to $3,000. Then it went to $60,000. Then it crashed to $16,000. Then it went to higher levels still. If you'd asked at any point along that journey whether it was the right time to buy, you'd get different answers depending on when you asked and who you asked. Silver's path will be similarly unpredictable in the short to medium term. So what do? You acknowledge that timing is partially luck. You can improve your odds through analysis, but you cannot eliminate uncertainty. You size your position based on your conviction and your risk tolerance, not based on certainty about timing. You enter gradually, if you're building a position, to smooth out the timing risk. You hold based on your thesis, not based on day-to-day price action. You adjust based on changing fundamentals, not based on whether you happen to buy at a perfect moment. The obsession with perfect timing is a trap. It leads to paralysis or constant second-guessing. It makes you reactive instead of strategic. Better to be approximately right about direction and committed to a plan than to endlessly wait for the perfect moment that never comes or that you don't recognize when it arrives. We've covered substantial ground. Let's bring this back to practical clarity. Silver is experiencing an extraordinary moment, physical shortages, price surges, liquidity stress. These are signals of a market under severe strain and possibly undergoing a structural change. The forces behind this are real. Monetary debasement, industrial demand growth, supply constraints, geopolitical uncertainty. These are not conspiracy theories. They're observable facts. At the same time, current prices are at all-time highs. Emotions are running strong. The setup has elements of both genuine fundamental shifts and speculative excess. Navigating this requires you to be clear about your purpose, disciplined in your approach, and honest about your risk tolerance. If you own silver, review your position. Make sure it aligns with your overall wealth strategy. Consider taking some profits if you're overallocated. Prepare emotionally for continued volatility. If you're considering buying silver, understand what you're buying and why. Don't chase prices emotionally. Don't use leverage. Start small if you're uncertain. Focus on physical over paper. For both groups, avoid the critical mistakes: emotional trading, over-leveraging, ignoring diversification, becoming attached to positions, trusting price predictions. Remember that silver is a tool, not an identity. It's one component of a financial strategy, not a complete strategy itself. The broader context matters. We're living through a period of monetary and geopolitical transition. The financial system that dominated from the 1980s through the 2010s is under stress. What comes next is uncertain. In such periods, having some exposure to tangible assets that aren't dependent on institutional solvency makes sense, but so does maintaining diversification, liquidity, and flexibility. Your goal is not to perfectly predict what happens next. Your goal is to position yourself to survive and potentially thrive across a range of possible futures. That requires thinking in probabilities, not certainties. It requires discipline over emotion. It requires patience over panic. Markets will continue to be volatile. Silver will continue to move dramatically in both directions. You will be tested, psychologically and strategically. The investors who succeed are not those who are right about every move. They're those who have a plan, who stick to it through volatility, who manage risk appropriately, and who maintain the emotional discipline to act rationally when others are driven by fear or greed. You have the information you need to make informed decisions. You understand the current market dynamics. You understand the forces at play. You understand the risks and the potential scenarios. Now it's about execution, about having the discipline to follow through on the strategy that makes sense for your specific situation. This is not about getting rich quick. It's not about beating the market. It's not about being proven right. It's about building and protecting wealth over time in an uncertain world. It's about making rational decisions in the face of incomplete information. It's about maintaining perspective when emotions run high. The current moment in silver is significant. It deserves your attention and careful thought, but it's one moment in a longer journey of financial stewardship. Approach it with seriousness, not panic, with analysis, not emotion, with discipline, not speculation. And whatever you decide, make sure it's a decision you can live with through the volatility that's certainly coming. Make sure it's sized appropriately so that if you're wrong, you survive. Make sure it's part of a broader strategy, not a bet the farm gamble. The opportunity in front of you is real. So are the risks. Respect both. Act accordingly. And remember that your most valuable asset isn't silver or any other investment. It's your ability to think clearly and act rationally when others cannot. That capacity will serve you far beyond this particular market moment. It will serve you across all the challenges and opportunities you face in the years ahead. Stay disciplined, stay diversified, stay focused on long-term wealth preservation and growth, not short-term excitement. The market will continue to move, opportunities will continue to arise, challenges will continue to emerge. Your job is to navigate them with wisdom, with patience, and with the emotional discipline that separates those who build lasting wealth from those who simply react to headlines. You have everything you need to make sound decisions. Trust your analysis, follow your plan, and maintain perspective through whatever volatility comes next. This is how wealth is built and protected through uncertain times. Not through perfect predictions, but through disciplined execution of sound principles.